Hello friends, this is Jitendra Kumar Mahapatra. Welcome you all to your channel, the UTKAL Investor. In the previous video, we discussed about the PE ratio and the earning per share. In this video, we are going to discuss about PEG ratio or price earnings to growth ratio. But before moving forward to today's topic, I would like to take a few moments to thank you and express my gratitude to all of you for making us a family of more than 100 members. I really enjoy sharing my knowledge and views with all of you, and I like to help you in any small way I can. This short journey till now has been wonderful. Still lot of miles to go and many adventures to come. So keep showering your love and support. Keep sharing the videos. Those of you who haven't subscribed to the channel, please consider subscribing it, and please share the videos with your friends and relatives to whomsoever you think it would be helpful. Now coming back to today's topic, those of you who haven't watched the previous video, first go and watch that video, then watch this video. Because without understanding the price earnings ratio and the earning per share, it is difficult to understand the PEG ratio. The concept of PEG ratio was popularized by the legendary fund manager Peter Lynch, my favorite investor. In both his books, One Up on the Wall Street and Beating the Street, he has described all his stock picking ways and how he used the PEG ratio to accumulate many valuable companies. I would request you to read both the books. It would be of immense help in your investing career. Normally, a stock having a PEG of equal to 1 is considered as fairly valued, whereas a stock having a PEG of less than 1 is considered undervalued, whereas a stock having a PEG of more than 1 is considered overvalued. The formula for calculating the PEG ratio is PE ratio divided by the expected earnings growth. Normally, a stock to be undervalued, the PE ratio should not be greater than the expected earnings growth. It is not prudent to use the PEG ratio in each and every stock analysis. Like in case of the cyclical stocks or the companies where the growth rate is very much inconsistent, it would not be prudent to use the PEG ratio because we would not get the true valuation picture in such cases. The PEG ratio should be used in cases of companies or stocks where the growth rate of the company for the last few years has been consistent. In general, the PE ratio is higher for a company with high growth rate. So if we value such companies using the PE ratio, the company may seem overvalued in comparison to its peers. So it is assumed that PEG ratio is the best parameter to value company with different growth rates. We can understand this with help of examples. Let's say there is a company A whose growth rate has been 30% for the last few years and is available at a PE ratio of 20. In this case, the PEG ratio would be 20 divided by 30 equals to 0.67. In this case, the stock is undervalued as the PEG is less than 1. Let's see another case where the company called B also has a PE of 20 and the growth rate for the last 3 years has been 15%, 20% and 30%. Here the growth rate is increasing at an increasing rate. But for a conservative valuation, I am taking the expected earnings growth for the next year to be 30. So in this case also, the PEG ratio is 20 divided by 30 equals to 0.67. Let's take another example where the company called C has a growth rate of 20%, 15%, 30%, 10% and 20% for the last 5 years. In this case, using the PEG valuation parameter would not be prudent as the growth rate has been very much inconsistent. We would not get the real valuation picture. Some analysts may suggest to take the average growth rate of the last 5 years. But according to my opinion, using other valuation parameter would be better in this case rather than using the PEG ratio. So that's it for today. See you in the next video. Till then, bye bye and take care.